Hello, hello.
What's up, everyone?
Good morning, everyone. We are at the final episode. This is episode 107 of The Raise. In case this is your first time here or you're just catching up, this is The Raise. It's a real-time interactive series on how to raise money, starring myself and Pankaj. The interesting thing or important thing I think to remember about the Raise is that it's not really a workshop or a seminar per se, but the purpose is to give you a behind the scenes look at the research. Sorry, the research. I'm totally like out of my mind today.
Yeah, that's
The
right.
research, the decisions, and the actions that I am taking while raising money for my new company, Fanabulous. We hope that by letting you in behind the scenes, you get to see a little bit of what we go through, the decisions that are made, and ultimately you get to understand the process up close and hopefully take some of these thoughts and starters and get yourself going in your own process.
I'm Pankaj, and I'm going to be working with the Fabulous team, mentoring them through the process and trying to give them some insight into how angels and VCs think and work. I'll ask the same questions that I ask when I'm investing in a startup. The only difference being that I'll also give some insights into the best way to answer some of these questions and also share what an investor might be thinking but not necessarily saying. More importantly, we want to know your questions. So if you've got questions, ask them in the comment section. Go to the website, foundercraft.com/raise, and you can submit a question there, or email us at raise@foundercraft.com. So, Greg, we're at the last episode going through the pitch deck. I think we got 3 slides to cover today. You want to hop right into it?
We will hop right into it. Let me just change this little thing. Yes. So I will tell you guys, it's been quite a month. I am happy to be in December. And this, the next stage or the last part of the deck is an interesting set because I think it's really the ask part, right? Or it gets close to really figuring out what it is that we're trying to accomplish or the whole purpose of the fundraising process itself. We have 3 slides that we're going to go through today. These are a little easier because I think they're fairly obvious what should be here, but Pankaj, I think you will have some good insights into what's missing potentially.
Yeah.
So one of the first slides that we need to think about relative to your describing your business is ultimately the team itself.
Yep.
Who are the people that you've gathered together to create this company and what are they all about? And I think much like in the previous episode, when we talked about sort of traction, was really like the same question was there. Are you a team that can execute? And as much as the work you've been doing currently is a reflection of your ability to execute together, the work you've done in the past is also a method of describing your ability. And I think a lot of times people make the mistake of describing their team not like by logos, at least in my opinion. I feel like people love to splatter lots of logos up about like, well, I was at Uber or I was at Google or I was at here or there or there. That doesn't necessarily show what you did, right? And that doesn't necessarily describe what's possible. When you're on a team with hundreds of people, what is any one person's contribution, right? It's very difficult. And it's important, I think, to really do your best to articulate why or what it is that you are all good at. And I don't even know, by the way, that I've got this right in our slide, but we'll see when we get there. What do you think, Pankaj? Oh, I think you're muted.
Sorry about that. Yeah, so, I think you're right. I think it's important to talk about what you've accomplished and what you've done in the past, individually and as a team. I think the logos are also helpful because it helps add credibility to some degree as to where you did some of these things, right? So, if you worked at a company and you were selling shoes and now you are at an AI company building something that is completely different, it's important for you to show where the context is of why where you were before matters, right? And why it's going to help you in this company. So the logo is important because it adds some credibility, but it's also far more important to show whatever you did in the past, no matter what company it was at, is relevant and important to building the success for this company, right? So
Right. Yeah.
you're right, and I think there's something that, at least in most pitches that I hear, most founders don't necessarily talk about what they've done in the past that would allow them to be successful this time around. And it's something that, usually we have to probe, and I have to ask questions and say, well, okay, what did you do at this company? Have you had any experience doing this in the past? And it's more of an exercise to pull that information out rather than it being given to me.
Yeah, and just, I guess, stylistically, what do you think is the best way to accomplish telling that story?
All right.
One of the challenges, for example, I've seen or I've had, you usually don't. You got like a tiny little 4-sentence summary, right?
Yeah.
And is this one of those cases where the in person is just really much more important than the sort of the written part?
Yeah, absolutely. I mean, the slide deck that you're mailing out to people is not going to provide any context, right? So, and this is where the logo piece of it becomes more important, to be able to show that, okay, I was at Google, and that immediately gives you some credibility, right? That you were at Google, and you graduated from Stanford or MIT or whatever. So that adds to your credibility. When you're talking to, again, that pitch deck that you're mailing out to people, your objective is to get a meeting.
Yeah.
When you get that meeting, now it's time to put some context around and say, look, I was at Google and I was on their social marketing team, and we were building products, whatever those products were. And, that flows directly into this. Or I was at, I spent some time at YouTube and trying to figure out how we can help YouTube creators build their fan bases and blah, blah, blah. And, that fits right into what we're trying to do at Funabulous. It's kind of like the next step, or it's at least related directly, right? So, explaining that in when you kind of get to the team, right? Like, you want to get through the other stuff that is interesting to the investor. And kind of when you get to the team slide, you got to explain, why are you and your team the right people to back, and how are you going to win this game, right?
Yeah, absolutely.
And your past experiences are important for that.
I do think so. And a lot of times, partially the experience is really part of what ideally you've communicated in some way already, which is why you were piqued to even enter this space, right? So a lot of the time, your domain expertise, the unfair advantage you have maybe is your relationships, your insights, your knowledge from a domain, or maybe an adjacent domain, or a new application of a technology to a new space or something like that. We actually have a good question that came in from Victor. Pankaj, I'll read it to you. How do angels think of distributed remote teams these days? Is that something that should be upfront during the raising of funds? Do they still want their teams, they're funding a car right away?
So, I think with angels, it's a little bit less of a issue than it is with institutional VCs. I think a lot of angels, especially angels on the West Coast, that have either been entrepreneurs in the past or have worked at really early stage startups, understand the need for remote teams. And, people are concerned with how do you get the best talent, and sometimes that talent isn't readily available in your local network, or your they might be occupied or whatever. So you're reaching out to folks, or you might know really great folks that are halfway across the globe, right? And today, with the technology and the ubiquitous communication platforms that are available to people, I think angels are a little bit more comfortable with remote teams. I think it's important to kind of identify that kind of when you get to the team slide, to show like, hey, some of us are remote. We're not all in the same location, but we address that by, being on a Zoom call every day, right? Or, Slack helps us kind of manage the product development, because we're all on it all the time. whatever, right? Like just explaining that if it comes up, but I don't think it's a big deal with angels. I know with a lot of VCs in Silicon Valley, it is still a issue. People are not fans of remote teams, especially really early on. They want to see people spending more time together, and it's kind of building that team and that camaraderie. So it could go both ways, but I think more and more VCs are starting to see that remote teams are okay in some cases, but they want to see evidence of it being okay in your team, right? And executing well, executing quickly helps demonstrate that.
Yeah. I guess, and you sort of touched on this in a previous episode, that I do think, as your institutional rounds do get larger, there's often, of course, I forgot to record. As your institutional rounds do get larger, sometimes there's a preference for this. But, we are seeing a trend as well. By the way, our company is remote to each other. We are seeing more and more companies embracing that remote first mentality. And I think some of the stigma is going away, relatively speaking. I think if you gave people the choice, they would most likely choose for you to be in the same place.
Absolutely.
Even founders, I think, often would probably prefer that. But there are benefits and upsides to doing things the other way.
Yep.
In a purely remote way. I think what matters is if you can prove you can execute in spite of what anyone may view as something that's detrimental. And honestly, that's probably the overarching rule for everything, right? Everything someone tells you is a bias they have. It's not a fact, right? They don't know with certainty that your business model isn't scalable. They don't know with certainty, right, that your team can't execute. Like, they just have fear from the last time they maybe experienced it or entered a domain. They have adjacent experiences with existing teams where they're seeing troubles or challenges that they aren't sure that you can overcome. So it's still always incumbent on us as the entrepreneurs to prove that those aren't impediments in the road to success.
Yeah, absolutely. I completely agree. Yeah.
So I think that is probably the most important thing for me to keep remembering as well, right? As you go and start actually talking to investors, you're getting both directional feedback, but also opinions, right? And when you spread it out over enough people, you'll start to realize if you are telling a story that is anticipating addressing the challenges that they may raise, right? And how you're going to do it. And by the way, there are some people you will never convince until you make them feel bad because you succeeded.
And that's okay.
And that's okay. That's totally okay.
Yeah.
So be okay with that.
Absolutely. People are investing money. They're in the business of making money, at least institutional investors. And, hopefully angel investors also will make some money. But, there's this underlying, and I've heard this so many times from founders, that angels are not really angels. They're just VCs without having large pools of money to deploy. Yeah, but at the end of the day, it's their money, right?
Yeah.
They don't have to invest that money, right? They choose to invest that money when something about the founders or the startup makes sense to them, and there's some sort of connection, right? So no one's entitled to getting money from an investor, right? And I think founders sometimes forget that, and I sympathize. It is very hard to raise money, no matter where you are and what you're doing. It's not always easy to raise money, but that you shouldn't feel or believe that you're entitled to raising money. And
without a doubt,
I unfortunately have heard that so many times from founders.
Yeah.
And it's it's like, well, I'm sorry, but people don't have to invest. It's unfortunate they choose not to, but it's their choice. It's their money, right?
Yeah.
It's not a charity. So
Yeah, it's their money, or they're either way, they're responsible for it, right? And so
yeah.
they're doing what they believe is best as well. I don't think that it is very rare. I have honestly very rarely seen it where it's more of a personal thing or a reputational thing, like where someone's just like, nope, never that guy again, right? If anything, I see it the opposite way, right? Like where people are like, entrepreneurs are like, I'll never work with that investor again, more so than the opposite.
Yeah, well, yeah. I mean, you see both. You know, there are definitely founders that I've invested in the past that I will never work with again. I will never provide a recommendation for. And then there are founders that, you know, it doesn't matter what they're doing, even you know, even if it's a small 5K check, I will still help them and back them if I can, just because they, you know, I really loved working with them. Right. So, you know, it goes both ways. And I know there are founders that definitely wouldn't want to work with me in the future. Hopefully they're the same ones that I would never want to work with.
Right. And yeah, so I do think it's just important. Remember, the team, there are things that your team needs, right? And I do think at heart still it's important to remember that just as much as what you have today, you also are telling a story about the ability to grab something in the future, right? And so you may know this in your own heart, like where we don't really have a lot of technical strength, or we don't really have someone who's like ever grown a business. Some of these things are okay to not have, and some of them really aren't.
Yeah.
Right. Like, you can learn a lot of things on the job over time, right? Like you will fill in more and more of your skills as you evolve.
Yep.
And that's expected, allowed, you know, and even sort of like, you know, commendable, right? But at the same time, if you're going out there describing building an AI-based platform, and you have no sense of, you know, no clear way for me to discern from looking at this slide, how would you know that you're doing something unique? How would you know how to execute this? How will you know how to react to the market? Those are reasonable questions to be asking when I look at a team.
Yeah.
Right. To understand sort of like what may be missing. And so you've got to do this delta and be honest with yourself. Like, do we feel we have what we need? And if we don't, that may be the need for you to still search for either a future or another co-founder potentially for a team, or have a plan in place to talk about how you plan to fill some of these important roles.
Yeah.
As things move.
Absolutely. And, you know, I think some of these things are, you know, they're not necessarily explicitly stated when you're talking to an investor. Some of them are implicit. They show in how you are reacting to certain things that are happening, or how a market is changing and what your perception of that change is, right? So a lot of these things are just, they're not necessarily explicit. They're kind of implicit. And, you know, investors might look for like verbal cues or body language to kind of determine like, right, you know, what is this founder, you know, stressed, and are they not able to like get through this issue that just came up, or this problem or this question, or, you know, are they sailing right through it, right? Like, so sometimes it's also important to know what questions might be asked, have an answer ready for it, right? Like, and this comes back to the research. Even if your team isn't necessarily ready to handle that, you know, have an honest answer of, well, you know what, we know we have this missing on the team. We know that we have to fill that out. And part of the money that we're raising right now is going to help us fill that out.
And it's better for you to take it on head on.
Yeah.
Than to leave that lingering thought. Like, are they even unaware? Are they just unaware that they need this, you know, or whatever it may be?
Yeah.
So
that's worse.
Absolutely. Yeah. So the next slide in our in here, and this is one that there are very many threads about. I actually almost want to do an episode and we're talking about potentially having a guest on to help us with this, because as I've been researching, I found about 1,000 different, the perfect template for your pitch deck slides, and they were in all kinds of orders, and some of them had different kinds of slides in there. And there were slides that we haven't done as part of our sort of exploration of this that I think may be worth sort of discussing, or maybe just as a roundup of other slides. And maybe that's an issue we should talk about maybe in a different episode, Pankaj. But just like the supporting slides, the appendix, like things you may want to prepare to complete the story or fill in the story as well over time. But I do think the roadmap is one that I sort of see, and sometimes it has different names.
Use the funds.
Exactly. Or product even. Sometimes it's really inherently like the roadmap itself. So we did give some thought to the roadmap slides. And for me, as I thought about like preparing these slides, or as I like work with other founders who are thinking about this, the real question is, where are you going? Right. And most people aren't, most founders are not necessarily product people per se. A lot of them are, right? But I think most founders like me become product people in the act of building, right? And so I would probably say I'm a product-oriented person, like by nature. But a lot of startups are founded by engineering people, or maybe by salespeople, or maybe by ex-operations people, or other kinds of domain experts. And you're not necessarily a product expert, and so, or that may not be in your physical career background. And so the real question is two parts. What's the clarity that you have about what it is that you are making? And then I think ultimately, where does it go to, right? Like what happens next? You're presumably going to take some of these funds to now evolve or move things into a new domain. And where are you going with those, with this next set of effort that you apply? And the real question, I think, is more so than like what it is that you are making. It's, for me, and this is a challenge I put to most product people, is how will you know when you've gotten there? Right? Because I feel like most of the time, product can be like quicksand. Like you can always find more things to add to it, more improvements to make, more polish to add. That doesn't necessarily make it tangibly or any more valuable per se, right? Like this is value like in our minds as opposed to necessarily in the customer's minds.
Right.
And so I think like there is an interesting thing or important thing for you to sort of understand when you define this, the roadmap itself, is to also expose or talk about what outcomes you expect to happen as a result of that, or accomplishing or reaching those places. What are your thoughts?
Yeah. So, I think those are really good points. I think, sometimes it's a lot simpler than that. Sometimes it's like some of these things could be things that you as a team are figuring out, right? But in your pitch, I don't necessarily think that you necessarily have to explain how well you've gotten there. I think what you really want to explain is like, hey, this is the product today. This is where we need to get the product, right? This is how we've spec'd out where that product needs to be. And this is the gap. This is the money that we're raising to fill that gap and get the product to this point based on our research, talking to customers, et cetera, or use your feedback. We believe that when we get the product to this point, we'll be able to do X, Y, Z, either in terms of revenue or in terms, if it's a B2C company, in terms of usage, what we can drive. So sometimes it's, at least when you're explaining it to an investor, it's simpler than that. It's like, look, the product is here, it needs to get here, and this is why it needs to get there. So hence we're raising this money to fill this gap and get the product to this point. Right. And
I don't in my slide I think I was a little more explicit about it, but but I think I agree with you. This is more of that in your head than it is like what's on the slide mentality. Right now, I think as you'll see when I show you my slide, I actually did put in like some metrics or KPIs because that's how I think. And so I wanted to be clear. Like I'm using our deck as much as like for clarity amongst our own team and like making sure that we're all in the same direction as I am like for an investor.
Yeah.
But I do think you need to understand the answer, right?
Absolutely.
Like what's going on there. And you need to be able to articulate why you think that, for example, if you've got three, this is the hardest part with all product is prioritization, right? And so you've got, I'm going to do this, and then I'm going to do this, and then I'm going to do this. How did you pick that order?
Yeah.
How do you know now that that's the order? And by the way, it's probably a guess, right?
Yeah.
But even if it's not a guess, you still use some internal litmus testing to sort of help you put things and prioritize things.
Absolutely.
That's what I think you're ultimately trying to describe, because that's where you can either display either a lack of focus or tremendous focus.
Absolutely. And a lot of that, that stuff that you're doing internally, that stuff that you're doing with your team. But once and this is probably truer with institutional investors, once an investor shows interest and say, okay, we'd like to put some money in, this might be part of their due diligence process where they'll actually sit down and maybe spend, a couple of hours just on product with you and talking to you about where the product's going and why you're taking it there and all of these other things, right? So, it's still important that you have these questions answered and that you've thought them through and you can spend time in detail if an investor is interested and as part of the due diligence process, kind of dive into some of this stuff.
Yeah, without a doubt. So that brings us to the third slide, which I think is a somewhat fairly straightforward one as well, which is really the question about, so what do you want? Why are you bothering me, founder? The funding slide. And, there's a few things, Pankaj, maybe I'll navigate for you, but this is definitely I think your area of expertise, but there's a few thoughts that I know we overlapped on here. And I think there's some essential things you've got to ask yourself. Like, how much are you raising, right? So if that's not clear and obvious from the slide, you probably have failed in communicating the most important part.
Yeah, and I think this is something that we talked about in one of the earlier episodes of, figuring out how much you're raising is, it's a process, right? And you have to have some justification for the amount of money you're raising, right? Of course, when markets are a little irrational, you may say, well, I need $300,000. And the investor will say, well, you know what? Why don't you take 750 just because I can't write a check smaller than 750. Right. So for a lot of times that can drive how much a company winds up raising. But, generally speaking, as a founder, if you haven't sat down and really thought about how much money you need to get not just the product, but get the business from here to here, then something's very wrong, right? And you probably shouldn't be in that pitch meeting. And I forgot which episode it was. I think it was like 2 or 3. I think it was 2. So we'd have a whole episode on figuring out how much to raise. But this is really important. You have a ask. This is how much money we're looking for. Some founders I've seen also say, hey, I'm willing to give X% for this amount of money. And other founders say, well, I'm raising between this much and this much. My personal opinion is don't put in a range, because having a range is like—
You mean a range for funds or a range for—
a range for how much money you're raising.
Oh, right.
So I'm raising
a number, like
200K and 400K, right? And it's like, well, which one is it? Because, if you're raising 400K, somebody can write a larger check. You can actually talk to an institutional micro VC that might be willing to write 200K check, or you could talk to an angel, so it changes dynamics a little bit. And it also shows lack of certainty of, well, all right, if you're raising between this and this, why is there a range, right? It just, for me, it raises more questions. It's like, well, there's a minimum that you want, and then you'll take anything above that. Well, yeah, that's true. Most people will take more, but that also affects the dilution, right? So you want to be careful with how much you're diluting, especially in the early stages, So if you are diluting too much, you're going to actually start hurting yourself in terms of raising money downstream. So, and then when it also comes to percentage, well, it's, I understand why founders do it, but it's almost a little presumptuous on the founder's part to say, hey, I'm willing to give, 5% for $1 million. Well,
Right.
why do you think your company's worth, $20 million? Right.
Yeah.
I don't get why you think that's the case. So that also opens up a whole nother set of questions. Founders aren't necessarily the best at figuring out what comps are in the marketplace right now.
Right.
And, VCs, especially at the early stage, typically look at comps when they're putting a valuation on a company.
And just to explain for everyone, when you're saying a comp, what you're essentially saying is comparable deals attempting to factor in, every star is fairly unique, but factoring in all of the vectors, the team, progress, market, etc.
Yeah. Like, hey, a company that came out of YC, they're generally valued at, this on the low end and this on the high end, right? So comparable companies will be somewhere in that range if they came out of YC. If a company is a pre-product company, they'll probably be within this range, right? And yes, of course, there's some differences, but generally, if you're in the US right now, a pre-seed round, it's pretty clear. If you're doing a safe note, it's probably going to be somewhere between 4 and 6 million, right? You're safe, the cap.
Now that you mentioned that, actually, is the method of raising. I didn't include that actually, but is that something you communicate here?
Yeah, so you can. There's nothing wrong with that. I think when you're raising an institutional round, a larger round like a Series A, you typically are looking for a lead investor. And in many cases, even a seed round, you're looking for a lead investor who's going to help set terms, right? Because they're going to write a larger check. They might have a preference for a certain type of instrument versus another. So you want to set terms with your lead investor. When you're raising a relatively small round, like a pre-seed round, you probably can go ahead and kind of self-lead the round, right? So you can say, look, guys, this is a no-brainer. We're raising 250K at a 4 mil safe, right? So it's capped at 4 mil. It's a 20% discount. It's kind of standard across the country. It's not like, all right, this is a really cheap deal, but it's also not like, all right, this is a really expensive deal. This is kind of like, all right, 4 mil, fine, whatever. It's fine, right? So,
and I'm curious if you could react to this. I have heard, some regionalized sort of pushback, that, like, now I'm in Denver. When I talk about like valley terms, people are like, "Oh, that's probably what you used to where you came from." Right?
Yeah.
What if you are raising in multiple geographies? I guess any advice? Just
so yes, geography does matter, right? And a valuation that is totally acceptable in the Bay Area is not necessarily what's acceptable in Denver or Chicago, and in some cases even New York. So yes, you want to be careful about that. You want to be able to justify to your local investors why you're raising at that particular cap, if you are. So if the majority of folks that you are targeting are in Denver, you want to look at what are comps for Denver, right? And say, well, 90% of the investors I'm going to wind up raising from are here in my local city, and 4 mil is not generally what Denver companies are raising at, right? They're raising at 3.5 or 3, so I might have to bring the cap down a little bit.
Yeah.
But if you feel like, hey, I'm going to raise most of my money from investors in the Bay Area, and 80% of the money is going to come from there, raise it at what is reasonable and comparable for early stage companies in the Bay Area. The Denver investors may or may not jump in afterwards.
Right. Yeah.
Right. So I think, that's kind of how you would handle it.
So another comment I put in here was to just, if you have some committed, it's likely useful to indicate what is
Yes.
open. And I think that's like in some ways some social proof. It's a little bit creates a bit of urgency.
Well, it can and can, and it may not.
If it's
Right?
like one, yeah, you may want to wait to a certain threshold, right?
Yeah, yeah. So I mean, I've seen folks say, "Hey, I'm raising 250K and I have $25,000 committed."
Yeah, I wouldn't talk about it yet either.
Yeah, exactly. It's like, okay, that's great.
Yeah.
Unless it's somebody very notable,
Right.
right? If you come out and say, "Hey, Elon threw in 25K,"
Yes.
and I spoke to him yesterday.
Right.
All right, that I would put in.
Yeah.
Right?
Yeah.
Like, it's not just, hey, I only got 10% raised, but it's like, yeah, I spoke to Elon yesterday and he put in 25K. So, that is one place where you would show a small amount, but generally speaking, I think 50%
Yeah,
committed.
that's what I was thinking.
Yeah, that's kind of like, hey, we've got 50% of the round committed already. This is what's left. And if there are notable investors.
Now, can I ask a question about this?
Yeah.
What is the protocol for when you can mention someone? Like, what do you recommend relative to being able to use, a logo or a name or whatever it may be?
Absolutely. Really important, because there are lots of investors, angel investors especially, that don't want to publicly talk about their angel investments, right? For whatever reasons. They're working somewhere. They are limited to, certain legal aspects of their contracts that say they can't do XYZ too much, right? So people have different reasons. Some people just don't want to be in the limelight, right? And they don't want to get bombarded with pitches. So they will ask them, hey, would you mind if I put your name and your face, a picture up on my slide deck saying that you're an investor? If they say, no, I'm not fine with that. Okay. Some people will say, look, I don't want anyone knowing that I'm investing. All right. Yeah. Pretty clear. Some people may say, look, I don't want my name and photo up on the deck or on the website or angel list or anything like that. However, verbally, you can tell people that I invested.
Right. That's what I've seen the most of.
Yeah.
I've often told people, like in my days with contracts at Shoot and whatnot, we would often joke that we spent more money redlining the clause where we said we could mention a client than anything else, because like no brand ever wants to acknowledge that they use your software.
Yeah, exactly. And I think with angel investors, it's a little bit similar. Some people are like, just want to be in the shadows. And then when it comes to VCs, even micro VCs, some of them will say, look, we're perfectly fine with you telling people that we are in. Others might say, no, keep it quiet. When a VC says no, keep it quiet,
you better.
Well, you better. But I also want to ask, well, why?
Yeah.
Why do you want to keep it quiet? Are you not sure that you're going to write that check?
Or, that's a good point.
Right? Or are you worried about somebody else, coming in and starting a bidding war and taking the deal away from you? I would want to know, why are you not okay with that? Like a lot of the deals that I used to do as a VC, I would tell people, like, look, I'm in. You can tell people I'm in, dependent on what the final terms are, right? So if terms change, I might not, right? But if the terms are what we're talking about today, then that's fine, right? So yeah, I think it's okay as long as you talk to the investor and you clear it with them and make sure what they're comfortable with.
Yeah, absolutely. So that's the first bit. The second bit of info, I think, on this slide is, which I've seen fairly commonly, but also I've seen slides that don't mention this, but I do think it's important. For me, I at least was like, how are you going to use this money? And so I've seen a variety of methods. I chose to go kind of like a bar chart, like, hey, we're going to allocate the money to this, this, and this, like these three things predominantly.
Yep.
Do you think this is important, or?
Yeah, I think it's important to mention how you're going to use the money, where it's going to be split. And, I don't think most investors are looking for exact numbers, but a pie chart that just shows, hey, 25% here, 25% here, 25% here, and 25% there. Fair enough. If those numbers start going out of whack, then somebody might ask a question and say, well, you said you're going to spend 25% of the money on, hiring developers, but instead you've spent 40% hiring developers. What's up, right? So
you should be so lucky you could hire developers.
Yeah, exactly. Yeah. So I think you want to have some way of just representing where the money is going to be spent. It's more important to investors because they want to know how you're thinking about it, not necessarily, worried about where the money is being spent, but more of how are you thinking about where the money needs to be spent to get the business to where it needs to be.
Right. Which was our next point of what's that get you to?
Yes. And so I think this comes back to the roadmap a little bit, right? Mm-hmm. And you could put this in the roadmap. You can put it here. It kind of implied like, hey, in the roadmap, we said we wanted to do this. Now we're telling you how much money we need to get there, right? And so this kind of ties back into the roadmap slide as far as as far as I'm concerned.
Yeah, I can see you could potentially have like the roadmap coupled with this.
Yes, slide. Absolutely. So I think both of them are very closely connected.
Yeah, because it's the use of funds basically is accomplishing something.
Exactly.
Without a doubt. Do you think how specific do you think or important is it to be specific here? Because I feel like honestly, I feel like most of the estimates we make as startups is like complete bullshit. So so I'm like, yeah, we're gonna have 10,000 customers. I mean, like, sure, I can make a spreadsheet that shows that, right?
Yeah,
like, that doesn't mean anything in the real world.
Yeah,
right?
No, absolutely. I mean, look, there are different investors who want to see different things. I personally don't care at all about your revenue projections because it's an Excel exercise. That's all it is, and anyone can do that. I do care about expense projections. I do care about what you think you can accomplish with the money that you're raising.
Yeah.
Right. So I want to see targets, not necessarily projections.
Right.
Right. So if you come out and say, if we raise this amount of money, we want to get the product to this point, that's a target by this date. And then we want to get to this many customers or this many users by this date. Right. You're setting targets for yourself.
Right.
And it's a way for you to hold yourself accountable as well as for the investors to hold you accountable.
Makes sense.
Right. So I think that's more important than talking about, Excel spreadsheets that show everyone going up and to the right. We've seen plenty of those.
Yeah. Of course, it's always going to do that. Right.
Yeah.
So and then the last bit, which we've covered, I guess, is just like how long is it going to last? Anticipated.
Exactly. This is, so this comes back to what I was talking about before. Your projected expenses, divide the total amount of money you're raising by your projected expenses, and you'll figure out how much runway are you getting from this raise, right?
Yeah. Now, I did something. I'm curious what you think. I just basically put no revenue in.
That's okay if you think that you're not going to have any revenue.
I do think I am. I just thought like whatever I was going to make up was sort of non-meaningful.
Well, I think that's important. It needs to be meaningful, right?
Sorry. I mean, like, I don't have a method of predicting it other than like just pretending these numbers are going to go in a certain way.
Sure. And right. Like that's the Excel.
That's the Excel part, right? Like for example, we plan to have a product that we could charge for like in a month.
Yeah.
Right. I just don't know what the uptake would be. And so like, until I have like a month of data or 2 months of data, it's very difficult to start to try and
I think it's perfectly fair to be honest about that with the investor and say, look, this is what our plan is,
right?
But we don't know if we don't know if 100 customers are going to pay $1,000 a month or 10 customers are going to pay $100 a month. We just don't know that yet.
Yes.
Right. We need to get a little bit further along before we can have some way of pricing the product and hence predicting what our cash flows are going to look like and setting reasonable targets. Right. So I think that's fair. right? For a really early stage company. And
but we got to adjust it. Like you can't.
What's that?
You do want to adjust it.
Yeah.
So I like, for example, in our slide, I basically said, for the $750,000, we expect it to get us to break even, because I'm not sure the rate at which it's going to happen, but I'm confident that in 18 months that will be the case.
Yeah, and I think that's okay, right? Like you, as long as you are being thoughtful in determining what you need to do, how much money you need to do it with, and how long is it going to take you to do, and have you planned for potential problems in between, right? I think that's fine, right? And generally, you want to raise 12 to 18 months of money in around. At the pre-seed stage, you're probably raising a little bit less. Maybe 6 to 12 months runway, just because you want to like show some sort of, I don't want to say you're not going to get to product market fit, but you want to actually show that there's some sort of traction that you can build with a relatively small amount of money.
Right.
And then you want to basically go out and say, look, we know that there is some interest in the product. People are willing to pay for it. Yeah. Now we need, a real round to kind of expand.
Yeah, you've ideally reached some meaningful inflection point.
Yeah, right? Exactly. Yeah. Exactly.
All right. Well, why don't we get into it? This is the deck as it stands today. I will be taking feedback today as well, and so we'll go through. But I've updated a couple of the slides actually from last time as well, so we'll walk through them again.
Yeah.
And we'll see how it goes.
Yep.
So our standard title screen.
Yep.
One question actually I've seen a little bit. Some people I've seen sort of indicate like
a version or a date.
Yeah, or just like which round it is. Is that, like?
I think, having a date or a version is good, just so that hey, which deck did I send out to so-and-so? When did I send it out? Especially when things are changing rapidly, right? Right. If you're actively fundraising and every day you're closing 5 to 10% of your total round, you might be updating your deck, once a week instead of, once every month, right? And if the product is moving very quickly also, you might wind up changing the deck around a lot more frequently. So having some sort of version number or date, at least for your own internal uses, is definitely important. Yeah. And sometimes like you may have an investor that's interested, they have an older deck, you can reach out to them really quickly. Hey, which version of the deck do you have? I want to make sure
that version number in also. Yeah.
So I want to make sure that I get you the most recent one.
Perfect. That makes perfect sense. So this slide, I believe I've left as was.
Yep.
I think we did some good work here in refining it. Same here, same as before. Wait a minute. No, it's not.
No, this is the same as before.
This is the old one.
Yes.
I had it where okay. We'd move this up. All right. There's a change version of this.
Okay.
Sorry, guys. I did change the solution slide.
Okay.
And because I felt like what I wasn't doing before, I was just talking about the products, but I wasn't showing how it was a solution to the actual problem that existed.
Okay.
And so what I tried to do here was to make a more comparative method. And I don't know if this is better, by the way, but it felt like I was showing why we're changing things or how we're changing things. And I may still work on this, but I wanted to show like traditionally what happens in that gray part.
Yeah.
And then how we were sort of filling in the gaps. Okay. And so the three key functions that I believe we help solve with are like lead generation, CRM, and marketing automation. So we have three sort of like sub products in our platform that map to these things.
Yep. So the question that I have here is, what are the gaps, right? Like you got organic and paid traffic to capture leads. Fine. That's, lead generation. You got a CRM that everyone kind of uses to prioritize leads and create prospects and all. So you haven't clearly identified the gaps here for me
The gaps in
that you're filling.
right.
It's not clear. Like I have to actually sit and I have to think when I'm looking at this slide, like what are you trying to tell me here? There are lots of CRM and marketing automation platforms out there. Now this is purpose built for social businesses. Great. There are some that are out there that are built for social businesses, not like the one you're building.
Yeah.
So it's not clear to me how your solution is different. I don't remember what the old slide was.
Is the lack of clarity, you think, though, I guess, the visualization or the concept?
I think it's a little bit of both.
Okay.
I don't remember what the old slide looked like.
Okay, I can get that.
I can't compare the two, but the whole story behind Fanabulous was that you are filling a gap that micro and macro influencers have in terms of engagement with their fans, right? And brands also fall into that in terms of the engagement that they have with their fans. I'm not catching that here.
Yeah. So let me just, for comparison, this was the one before. So this was how I was showing it before. So I guess what I'm saying is, or what I'm trying to explain is that in a linear process of going from like prospects to customers, right, which is a universal process for all marketers and any business really, right, that in the traditional world, there's sort of this well-worn pathway where there's tools like, HubSpot, Salesforce, et cetera, et cetera. And then we're the version that's currently missing in that universe for the social pathway.
Yeah. So I think what I like about this version of the slide better is that you clearly show a progression from followers to fans to customers, which you don't have in the new slide.
I agree.
Right. So I think that's to me, those should be bigger and they should stand out more.
Okay.
Even here, they're subdued.
Yeah.
They should be bigger because you're basically just saying, look, this chunk here, Fanabulous asks is where we're engaging with followers, activating them.
Yep.
And that leads to, fans.
Yes.
Which fan bases can track and organize and et cetera, which then pushes them into Fanabulous automations to turn them into actual customers.
Yeah.
Right.
Okay.
To me, this just visually as well as conceptually is now like, all right, I'm looking at it in a way that shows me very clearly lead generation, CRM, marketing automation is, what traditionally people have been doing, but it hasn't really led to engagement as well as what you guys are planning.
I may take another stab at this yet, but I get your point. Like, I want to show we're filling a hole. Like, visually, I want to show we're filling a hole, right?
Yeah.
Like that there's a thing missing. And, I think like what happens is here we sort of allude to the hole.
Yes.
And I want to drill into there now and like show like why we're really, really relevant. And so I get why the newer version doesn't do as good of a job as it should. And I see this, I have an idea. I will update it.
Okay.
But yeah, but you can see, like, again, for everyone out there, this is what happens. Like, you will second guess your own stuff. You will try like, new things, and it may be better, and a lot of times it's not.
Yeah, and that's okay. All of this
Yeah.
is an evolution.
Totally, you're learning, right? Like, by the way, like, I guarantee you, if I was speaking through it, it'd be fine. But as a read, it's I think the challenge.
Yeah.
All right, cool. So product, I haven't changed either. I left that alone for now. These were all the same. Traction is still the same. This is the slide I hate the most in the deck. So as soon as we launch the beta, I'm going to throw it all away and replace it with some charts up and to the right. I did redo the revenue slide as well.
Okay.
Because I did not feel that my last one necessarily conveyed clearly enough how we're going to make money. And so what I tried to do here was actually show it like I might show it on the site.
Mm-hmm.
So this is more of a, hey, we have like these 3 SaaS products, our Asks product, our fan bases product, our automations product. And this is, we're going to have a free tier for everything. We plan to have, a basic step up tier called Plus, and then a pro tier, which will charge, like slightly more. And then, what I didn't do a good job of here yet is just talking about like how big any individual account could grow to, right?
Well, you can always add in an enterprise.
Yes, so I could add like an enterprise or actually even a second slide on revenue, because I do think like our fan packs, and because we grow with the customer base and stuff like that, is important. What I did do at the bottom is try to add like a little bit of an example. I saw a lot of people do this, and I thought it was pretty helpful.
Yeah.
So for example, a brand with 20,000 followers would pay $125 per month. Capture Manager convert 5,000 fans.
Yeah, I think this is good.
Yes, I just felt more clear, simpler, like less having to squint your eyes to read a bunch of stuff.
Yeah, no, I like this. This is good.
And you can see like, all right, great. Well, I'm going to have more than 5,000. So yes, you can imagine it'll get higher and higher over time. The competition, I took another blow at and came up with something quite different. This is actually a link you'd sent me. I had a really interesting visualization. And I do think because in some ways we're trying to create a market that blends many different things, instead of trying to do it, I found it very hard to try and compare us to one thing or the other.
Mm-hmm.
So what I'm trying to show is really we're at the intersection of several key marketing tools that are in play for modern marketers, or as I call them. And now, adapting them for social marketers. So the CRM stacks, the marketing research stacks, the survey stacks, and the marketing automation stacks.
Yeah, I like it. Looks good.
Cool. The team, here's one of the new ones for the week. So this is the 3 of us and our mystery person who I won't share here, but in the real one won't be covered up.
Yep.
But so I tried to, I did a couple things in the headline here. I proactively stated we are successful. I think we've been through accelerators, we've had exits. We've built products that generated revenue. I think that those all count. And most importantly for me,
whoa, did we lose Greg? Uh-oh.
I hear you.
Oh, now well,
I think we're still good.
All right.
All right. So I was saying, I just thought that the relevance of like us working in the domain, particularly useful.
Yes. So the only thing that I'll add here is throwing a couple more logos. Look, you're a visual person.
Yeah.
When there are more visuals on a slide, it just appeals to people.
So you think logos for the companies we worked at, because they're all like startups I may not have heard of?
Just anything that adds credibility.
Okay.
Right. So it could be, hey, Peter went to Stanford. All right, let's throw a Stanford logo up there.
Yeah.
You went to NYU, throw an NYU logo up there.
Is that good for anybody?
Well, I don't know. Maybe if you're looking for a job on Wall Street or on Madison Avenue, but not necessarily startup world. But so I would just throw up a couple more logos that are legit and add some credibility.
Yep.
I think that helps. Other than that, this team slide looks good. You know, this is a team slide that, you know, people just, you want to lay out who you are and where your relevance is, and now the conversation can happen.
Yeah. Right. Okay, perfect.
Yeah.
Good. All right. I will make those additions as well. Now the roadmap slide.
Yeah.
So I did basically, as I've shown now previously, we have like sort of 3 mini products like inside of the platform.
Yep.
We have like a very intentional order that we want to roll them out in.
Yep.
Starting with asks this quarter coming, then our fan base product, then our automation product,
Yep.
and then a new variant that we plan for in the future, which I would speak about with people, but I don't want to be focused on per se.
Okay. So when if you're including this in the deck that you're mailing out to folks,
I don't know. Should I?
I don't think so.
Yeah.
Because this could just raise a whole lot of questions.
Yeah.
And you speaking to those things is probably a better idea than somebody reading about it. So,
right.
You know, some of these, I would leave this out because, you know, if I was just looking at this without
context,
without context and without you explaining it to me, I'd be like primary KPIs, total users, total fans. Like, are those your KPIs or are those the KPIs of your customers?
Sure. And they would definitely be ours. So like, that's how we're going to measure. So this is, and this was that point I was trying to sort of make earlier. We will measure effectiveness and if we should continue to go forward, I think based on these numbers. Like if we're not acquiring enough users yet on the first product, then we don't really need to launch the second one.
Right.
The same thing. And also like why we track fans, I don't think would be clear without an explanation.
No, it wouldn't.
It's not. So I could also just remove that.
You know, if you think it's important, then leave it in when you're explaining it. Yeah,
I think this slide, I agree. I wouldn't want to mail this out like without someone having me explain why we're doing it the way we're doing it.
Yeah.
And also I think there's a storyline to why even they're in the order they go in.
Yeah. And, you know, don't forget the deck that you're mailing out is really just a teaser to like set the expectation of what this business is and is this of interest to me as an investor? If the answer is yes, let's do a meeting and now let's dive into all this stuff in detail. If it's not, hey, thanks for the deck, but no thanks, I'm not interested.
Yeah, absolutely. And at some point I will package this up into that version as well so we can see it. So but there is a roadmap, fairly simple and straightforward. I didn't really plan out beyond a year really.
Okay.
I think as a product person, I find it completely unreasonable to think beyond that.
Yeah.
But it does show and start to articulate how we plan to go to market a little bit, like who we're planning to reach out to and who each product is going to sort of benefit the most.
Yep.
And I can explain all those things in the actual pitch. And then, the funding, I tried to indicate, look, we're doing a $750,000 pre-seed. Most of our money is basically being spent on salaries.
Yep.
Our infrastructure, and then some small other incidentals. It will give us 18 months of runway, and we imagine getting to break even in that time frame.
Okay.
Oh, and I guess I forgot the last one.
So just one question.
Yeah.
Funding slide. From this bar chart, it looks like 90% is going to be salaries.
That's right.
Okay.
Yeah, we are basically, and again, it's in the voiceover part, I guess, really, right? But we don't plan on hiring any folks, but we do plan to pay ourselves a fairly normal salary. And we have basically the 4 co-founders and 1 designer on contract, and that's all we're planning to hire for the next 18 months.
Okay. Just, be prepared for investors asking a lot of questions of why you guys are going to be paying yourselves market salaries.
Yeah, sure.
Right. Like there will be investors who are going to ask you that. And, some investors are going to say, well, I'm not comfortable with you drawing a full market salary.
See you later, guys.
Yeah. I mean,
it's true. And I'm not going to I won't debate with them because I'm not budging on it either. Right. I feel like, I think it's a fair point. I'm not taking a full market salary, right? But I'm taking a salary. I'm not going to pay myself.
No, I think salaries are fine, right? Yeah. I'm just saying when you're raising around and you can show that 90% of the money being raised is being spent on existing founder salaries and no real new hires, it's going to raise questions.
Yeah, I think that's fair. Absolutely. But I also believe like we're an extremely capable team.
Yeah.
And I could go hire a bunch of really crappy people to fill in all the parts if that made them feel better.
Yeah. I hear you.
Yeah. But look, and that's again, I think like entrepreneurs out there, you got to remember, you have to know what you need to stay motivated, to stay involved, to stay doing this. And, you know, like if everyone tells you no, then maybe you don't have the right stuff to be able to demand that. Maybe that's what people will tell us. And then we'll have to figure out how to adjust.
Yeah.
But
yeah,
this is my starting ante and we'll see how it goes.
Yeah, no, absolutely. Cool. Okay.
Yeah.
Nice. So
we are almost at time. So listen, we're going to wrap up this episode today.
Yeah.
The next month we have we will be resuming in January, I believe. There's a small chance we may do another episode this month.
Yep.
But we haven't necessarily locked down the date yet for it. If we do, it will most likely be just a look at maybe like some of the appendix and some of the other slides that you may want to pay some consideration to. And we have like a great guest that we're hoping to get to sort of come and talk about those things. Someone who's helped design hundreds or thousands of decks actually. And so if we can get him, we may do an episode, and also if there's time.
Yeah.
If not, we may do that in January. We are trying to figure out like what to do next. So what we would really love from everyone watching, if you're watching right now, if you're watching later, leave a comment below about some of the things you'd like to see next, because there's a lot of ways and directions we can go. We are thinking about, for example, an episode on how to manage your lead list, like sort of the like guts of the process, like how do you set it up?
Who should we raise from?
Yeah, you know,
how
some
do we
more
reach out to them?
Into that piece.
Prepare for our first pitch meeting.
Yep.
And then, you know, following up with the folks that we have pitched.
Absolutely. We're also looking at potentially getting some great, some angel investors to come and provide some of their just raw feedback on, not like on my business per se, but more on what are the things they like to see, what are the things they don't like to see, do's and don'ts, you know, and some of them, maybe their war stories as well. And then of course we are considering potentially having me pitch live to some potential angels to get their feedback in real time as well. So we're hoping that we can get to potentially seeing some of the actual pitching and some of the real feedback from this deck. So one variation of that, one way or another, it may be I may pitch some people anyway, and I may ask them to come on and talk about what they liked or didn't like after the fact. We'll play with some variations on that, but we do want you to be able to get to see some of the other side of the process once we get into the actual fundraising effort as well. And there, you know, as we said, our goal is for January or so for me to actually start really trying to fundraise.
Yeah. So let us know your thoughts. If there's specific things that you'd like to see us cover as Greg starts the process of raising and pitching, let us know. Otherwise, we will post the schedule up on the website, foundercraft.com/raise, probably in the next 2 weeks. And if we don't see you guys again before the holidays, happy holidays, and we will see you soon.
That's right. I think I didn't put any other sides. Well, happy holidays, everyone. In case we don't see you, by all means, leave us a like, a heart, whatever it is on whatever service you're watching. That's how we know if you've been paying attention, if it's been useful to you. Give us your feedback and your comments on what you'd like to see next. Again, all of these episodes are available at foundercraft.com/raise, and we look forward to seeing you next year as well.
Thanks, everyone.
Bye, everybody.
Take care.